Bank robbers have been around ever since banks were invented. When asked why he robbed banks, Willie Sutton, one of the most notorious criminals in the 1920s and 30s, said, "Because that's where the money is." While historically bank robbers used guns to steal money, today the keyboard has replaced the gun. With almost all financial assets recorded digitally, computers are the new safes requiring cyber risk protection. Computers of financial institutions are even more so because that's where the money is. In fact, our 2024 Global Financial Stability Report observed that nearly 1/5 of all cyber incidents affect financial firms. Several factors explain why financial institutions are targets of choice. First, financial firms collect, process, and store a great deal of personally identifiable and sensitive information which can be sold on the dark web. So, criminals go for it. Second, very complex IT systems used in the financial sector, including legacy systems, give rise to vulnerabilities that could be exploited. Threat actors are not all financially motivated. Some may seek to disrupt operations, for example, to undermine trust and cause economic and reputational damage. In the worst case, this can be part of cyber warfare. Yet others, although in diminishing numbers, may want to draw attention to a cause or simply prove a point by destabilizing critical infrastructure like the financial system. Since COVID prompted large-scale telework, there has been persistent and growing consumer demand for digital delivery of financial services. Digital delivery also helps financial inclusion, so there is a nudge from policymakers as well. It's expected that by 2030, half of the world's population will use online banking. The financial sector is adopting new technologies at an increasing pace, such as cloud computing, artificial intelligence, and machine learning. There's open banking, open finance, banking as a service, account aggregation, and other innovative fintech solutions, all relying on more and faster communications between various systems. As a result, we expect even tighter interconnections and more complex interdependencies, including with third parties. So the attack surface is bound to grow. At the same time, cyber attacks are continuously evolving, becoming more frequent and sophisticated. No wonder cyber risk is typically listed among the top 3 risks the financial sector faces. The Depository Trust and Clearing Corporation's Systemic Risk Barometer surveys rank cyber risk in the top 5 every year since 2013. Because of the growing attack surface and intensifying malicious activity, cyber risk is on a long-term increasing trend. We must keep abreast of this trend and improve the financial system's cyber resilience. Indeed, standard setters like the Basel Committee on Banking Supervision, the Financial Stability Board, the International Association of Insurance Supervisors, and the International Organization of Securities Commissions have increased their attention to cyber risk. The question now is, how exactly can cyber risk impact financial stability?